Welcome to this explainer. Today, we are putting ARC Capital Group, ticker ACGL, through the ultimate investment gauntlet. We aren't just glancing at a standard earnings report today. Instead, we're going to evaluate this insurance giant using the exact frameworks of legendary investors. We'll extract the raw data from their recent financial supplements and analyst reports and feed it directly into the methodologies used by the absolute masters of the market. Let's get started. Here is the game plan for today. First, we'll do a quick ACGL company snapshot. Then, we'll evaluate the stock through the Buffett lens, the Lynch lens, and the Graham lens. After that, we'll check out some market valuation models. And finally, we'll wrap it all up with our final investment synthesis. All right, Section 1, ACGL Company Snapshot. So Arch Capital Group is a total heavyweight in the global financial arena. Based on the data we're reviewing, the stock is currently sitting at $100.64, with a staggering market capitalization of $35.16 billion. What this means for you as an investor is that this isn't some tiny speculative play. We're talking about a highly capitalized, mature financial institution that really anchors a portfolio. Looking at how they actually make their money, they've got this deliberately diversified setup. It's almost an even split, with 48% of net premiums coming from primary insurance and 45% from reinsurance. But here's the real secret weapon. That remaining 7% is their mortgage segment. It might look like just a tiny slice, but it acts as a massive, highly profitable stabilizer for the entire operation. So how are they actually holding up right now? Honestly, incredibly well, though they do face some real headwinds. They pulled in a massive $893 million in after-tax operating income in just the second quarter. And what are they doing with all that cash? They're aggressively buying back their own stock, literally $1.2 billion worth in Q2 alone. But you gotta keep in mind they're doing this while navigating the early stages of a soft market cycle, which basically means insurance pricing is dropping and competition is heating up.
Moving right along to Section 2, the Buffett lens.
Arch actually breezes right through Warren Buffett's strict quality checklist. First off, Buffett absolutely loves a high return on equity, and Arch delivers an impressive 18% annualized net income return on average common equity. Secondly, they aren't juicing those returns with crazy leverage. Their debt-to-equity ratio is sitting at an incredibly low 0.15. And finally, you know Buffett is a huge fan of buybacks when a stock is intrinsically cheap, right? Well, Arch repurchased a staggering $1.95 billion in shares in just the first half of the year. But remember, Buffett invests in people, too. And CEO Nicholas Papadopoulos' recent mindset perfectly captures what you want to hear. He explicitly stated they aren't going to chase market share just because the environment is getting more competitive. Instead, they're demanding greater discipline in how they deploy capital. I mean, that is exactly the kind of honest, shareholder-friendly discipline Buffett looks for in a long-term compounding machine. So, boiling it down for the Buffett lens, ACGL is a definitive buy. You've got a high-quality compounder, a clear economic moat, a fortress-like balance sheet, and a management team that treats capital like the precious resource it is. All right, let's switch gears. Section 3, the Lynch lens. If we're using Peter Lynch's categories, Arch is a textbook stalwart, just a reliable, mature company consistently compounding earnings. Lynch would be a big fan of their steady underwriting income, especially that $220 million from the steady mortgage segment we talked about earlier. But we do have a few red flags here that give us pause. We're seeing a high PEG ratio, and recent SEC filings show some insider selling, specifically Director Brian S. Posner unloading 3,000 shares. Let's actually zero in on that PEG ratio for a second, because it's a huge deal in the Lynch framework. As a quick refresher, the PE ratio divides the PE ratio by expected earnings growth, basically telling you exactly what you're paying for future growth. Arch's elevated PEG score of 5.30 suggests that the current $100 stock price might be running a bit ahead of its immediate growth prospects, particularly since they're intentionally writing fewer premiums in this softer property market. So, blending all that together, the Lynch framework spits out a conservative hold recommendation. While the stalwart fundamentals and the balance sheet are rock solid, that high PEG ratio combined with those insider sales means a strict Lynch investor would probably sit on their hands, waiting for either a better entry price or a reacceleration in growth. Next up, we have Section 4, the Graham lens. Let's see how it holds up. Okay, time to do some math using Benjamin Graham's legendary defensive investor formula. We take his constant of 22.5, multiply it by Arch's expected earnings per share of $9.34, and then multiply that by their current book value per share, which is $68.04. We take the square root of that whole thing, and boom. We calculate a fundamental intrinsic value of roughly $119.55 per share. And wow, this calculation reveals a seriously striking value proposition. When we compare that calculated intrinsic value of $119.55 against the current trading price of around $100.64, a really compelling picture emerges for value investors. The market is basically pricing this stock significantly below its fundamental worth. What we're looking at here is a very solid margin of safety, with intrinsic value sitting about 15% higher than the current price. Because it's trading safely below what it's fundamentally worth, a strict Benjamin Graham analysis would absolutely classify ACGL as an undervalued buy today. Now let's check the temperature of Wall Street. Section 5, Market Valuation Models. If we look at alternative discounted cash flow models from Wall Street, even assuming conservative terminal growth rates and a standard weighted average cost of capital, they actually align pretty perfectly with our Graham calculation. Wells Fargo recently bumped their target up to $117, keeping an overweight rating, which implies over 16% upside. The broader consensus average is just a bit lower at $110.04, but crucially, both of those targets sit comfortably above today's share price. Looking at broader street sentiment, it's a bit mixed, but definitely leans positive. Out of the analysts currently covering the stock, 8 rated a buy, 7 have it as a hold, and literally only 1 says sell. It's pretty clear that even though the market sees the insurance cycle slowing down, they have a ton of respect for Arch's profitability and that massive capital return program. All right, let's bring it all home. Section 6, Final Investment Synthesis. When we blend all these insights together, Arch Capital really emerges as this highly disciplined, undervalued asset. Buffett is going to love the 18% ROE and those massive buybacks. Graham is all over that $119 intrinsic value because of the 15% margin of safety. Really, the only yellow light comes from the Lynch lens, which flags the high PEG ratio on those insider sales, leading to a hold. But the big takeaway here? This is a total fortress of a financial company. They are actively buying up their own undervalued shares rather than chasing bad business, and that is huge. But I want to leave you with one final provocative thought to chew on. We know for a fact that the property insurance market is softening. Premium growth is shrinking because Arch is smart enough to walk away from underpriced risk. So in this shrinking rate environment, can management's strict discipline and their billions in share buybacks actually outpace the headwinds of a soft market? That is the ultimate question for anyone looking at ACGL right now. Thanks so much for joining me on this explainer. Keep analyzing, and I'll see you next time.